We're back on the TD Ameritrade Network. I'm Renita Young, filling in for Oliver Rennick. And it's time to welcome in Kathy Jones, Chief Fixed Income Strategist at Charles Schwab, and Michelle Gibley, Director of International Research at Charles Schwab. Thank you for joining us, ladies. Kathy, let's start with you. Jerome Powell speaks this week. What are you thinking we'll hear?
Well, I think he'll reiterate his position and the Fed's overall position that their plan continues to be hike and hold and recalibrate when something changes. And so I don't think that there's any chance that he'll deviate from that. He'll talk about inflation being stubbornly high, concerned about services, maybe the labor shortage, keeping wages strong. On the other hand, I don't think that he'll try to draw a specific timeline. So I think the message will be, we're just going to keep at it. The job is not done. We'll keep at it for as long as it takes. And then the question becomes, well, what are the indicators that the Fed is watching? And that's where we'll maybe get a little bit of information from him. I'm not so sure.
And even after that, how do you think bonds are going to react to whatever he has to say?
Well, I mean, I think the market is telling you pretty strongly its view that it does expect the Fed to get inflation down longer term. We've got that deeply inverted yield curve. That's a signal that the market says, yeah, the Fed is actually going to go to 5.25% or whatever, and get the economy to slow down, get inflation down. So longer term yields are drifting or staying below. In fact, the deeply inverted yield curve right now is 2-year, 10-year at minus 90 basis points or so. A year ago, when we started the tightening, it was plus 157. So it's had a huge, huge move. And I think the market is saying, yeah, we know the Fed is there. So I don't expect the bond market to shift a lot unless, Powell surprises us with maybe a more dovish message, but that seems unlikely.
That's fair. Now, Michelle, as we look at central banks, we're also going to hear from Australia and the Bank of Canada this week. So what are you watching, though, globally?
Right. We get the developed economies of Australia, Canada, and Japan as well. So tomorrow, Australia kicks it off. They're expected to hike rates by 25 basis points. And last month, although they did 25, they actually debated a 50 basis point move. Now, Canada has said that a pause may be needed, but they may need to hike further if their job market remains tight. They've reported really some blowout job reports the last 2 months in a row, and they'll report jobs on Friday, but that'll be after they meet on Wednesday. And then we have the Bank of Japan at the end of the week.
Now, Kathy, back to you. The 2s and the 10s specifically have been a central focus in the past few weeks. Will that kind of volatility continue as we go through this week?
I think so. I mean, when you think about positioning for this week between Powell and then the jobs report on Friday, I think what you'll see is that the curve will be where people place their trades rather than outright positions. Because a lot of people got really burned on that last jobs report. They don't want to go in with an outright position one way or another. So I think that there will be a tendency to try to trade the curve. And that leaves that 2 to 5 year area, what we call generally the belly of the curve, kind of vulnerable to the most volatility. So that's where I would expect the market to see the biggest changes, just because it would reprice one way or another for expectations about the Fed.
Michelle, international stocks benefit from that same volatility, but what's the case for considering overseas equities?
Right. Actually, international stocks have been outperforming this year. And they are benefiting from the uncertainty we're seeing, about the global economy and inflation, where monetary policy is going globally, and what it means for risk assets. So we expect this volatility could continue. And, we have this growth is a little too strong, inflation is a little too strong. So in the meantime, having a diversified portfolio that includes an allocation international can help. They have a higher weight in quality factors such as short duration. In other words, they have more cash flows in the near term rather than off in the future. And those low price to cash flow ratios are what markets are really favoring this year. And we're seeing investors put more money into international ETFs and mutual funds this year and taking them out of U.S. stock funds.
All right, ladies, thank you so much for the insight. Always appreciated. That's Kathy Jones, Chief Fixed Income Strategist at Charles Schwab, and Michelle Gibley, Director of International Research at Charles Schwab. Thank you.